We expect the RBA to cut rates faster and deeper than the consensus expects, and that's bullish for Australian equities. We've been optimistic on the equity market backdrop, and thankfully that's been on the right side of the ledger. As we go into the second half of the year, returns for equity markets have been very solid. US and Australian equities up around 5%. Asia is up around 12%, and emerging markets are up in excess of 15%. Very solid returns given the volatility that we've seen yet. Going forward, we think equity investors need to be overweight. If you aren't, then we would be using any weakness over the next few months to actually get positioned in cyclical sectors. There's a view that markets have been complacent. We don't agree. While there are risks, US growth, inflation, higher oil prices, geopolitics, we think the way that markets have absorbed these risks show resilience rather than complacency, and we think we are past peak uncertainty in regards to downside equity market risks. Outside of a US recession, lower policy rates in combination with a solid corporate profit backdrop is very bullish equities, and we think that's the backdrop that will prevail for Australia as we move forward into the second half of the year. May's CPI print was better than expected at both a headline and core level, and very encouragingly, we also saw positive developments in terms of services inflation and housing inflation both stepping down. We think this gives the RBA a green light to cut faster and further than the consensus currently expects. We think rates will fall at least 100 basis points, maybe even more. If we go back to the period pre-COVID, for the 6 to 7 years, real policy rates in Australia were below zero, and it wasn't aggressively stimulatory. We think that nothing has changed, and so we use this as the backdrop for where policy rates may get to over the second half of the year and into 2026. For Australian investors, this is a very positive backdrop. We expect rate cuts by the RBA to have a 2 handle in it by the middle of 2026. Corporate profits are very solid, with corporate profit margins allowing some leverage as we move forward into the second half of the year and further into 2026. At an international level, global growth is slowing, but it's still solid, and we do expect other key central banks to begin to pick up rate cut momentum as we move into the back part of the year and into 2026. When we put those factors together, we think equity markets will trade meaningfully higher by year end. It would be remiss if we didn't talk about downside risks for equity markets. They are, of course, not a risk-free asset. But we think going into the second half of the year that the concerns that have been overweighing the market, such as US growth, such as higher bond yields, such as geopolitics and oil concerns, will be risks that are absorbed by equity investors. We think the biggest concern is elevated valuations, but going forward, we know that valuations are not a constraint to further upside if fundamentals are improving. If economic growth is improving, if policy rates are falling, if profits are continuing to rise, then we think that these are enough and powerful tailwinds to actually ensure that equities can look through other risks as we move into the second half of the year.